Hello, everyone. Welcome to a new episode of the Gay Husbands on Fire podcast. I am Jay from Gay Husbands on Fire. My husband G and I are on a journey to financial independence and early retirement, also known as FIRE. And we have been sharing our story with thousands of followers on Instagram at Gay Husbands on Fire. G and I started this podcast to continue to educate folks about personal finance, share a little bit about our experience as two gay guys trying to build a life of financial independence, and connect with like-minded people around the world. This is the third episode of this podcast. If you are listening on Spotify or Apple Podcasts, please make sure to follow our show. If you are watching on YouTube, please like this video and subscribe to our channel. In today's episode, we will talk about the different types of investment retirement accounts that are available in the United States. So if you still think that 401k is some sort of race for runners, or if you have always been too scared to ask your dad what an IRA is, this episode is for you. Let's begin.
Hello, everyone. I am G, the other half of Gay Husbands on Fire. Jay and I are very excited that you are listening to this episode today. Thank you for being here. So, investment retirement accounts are an excellent way to save for retirement. And in the United States, there are several types to choose from. Each type has its own unique set of rules, benefits, and drawbacks. There are also different rules around who can contribute to each type of account and how much money you can invest. This episode is being published in March of 2023, so all amounts we will talk about here are current as of that date. So if you are listening to this years later, make sure to check online for updated amounts, as these tend to change every calendar year. Okay, let's start with the good old traditional IRA. IRA is an acronym that stands for Individual Retirement Account. We call it traditional in order to distinguish it from other kinds of, let's say, special IRAs, which we will discuss later. A traditional IRA is a tax-deferred retirement account. When we say tax-deferred, this means that the money you contribute to a traditional IRA is not taxed until you withdraw it in retirement. This also means the money invested in your traditional IRA grows tax-free until you withdraw it. Here's how it works. Generally speaking, when you contribute to a traditional IRA, you can deduct the contribution from your taxable income for that year. The IRS sets a limit every year for how much you can contribute to an IRA. For 2023, the limit is $6,500 for everyone younger than 50 years old. If you are 50 or older by the end of 2023, the contribution limit is $7,500. This can reduce the amount of taxes you owe in the year when you made the contribution. Also, before you withdraw money from your traditional IRA, you won't pay taxes on any dividends that you may receive from your investments in the IRA. However, when you withdraw money from your traditional IRA in retirement, you'll pay taxes on the total amount you withdraw at your ordinary income tax rate at the time of withdrawal. For example, if you contribute $5,000 to a traditional IRA in a given year and your tax rate is 25%, you can deduct $1,250, meaning 25% of $5,000, from your taxable income for that year. So you'll pay taxes as if you earned $1,250 less that year. But when you withdraw those $5,000, plus any earnings, in retirement from your IRA, you'll owe taxes on the full amount at your ordinary income tax rate at that time. So, tax deferral can help your investments grow more quickly because you can reinvest the money that would have gone towards taxes. But it also means you'll owe taxes on the money in the future.
Great. Now let's talk about a real darling of the personal finance space, the Roth IRA. A Roth IRA is a type of retirement account that allows individuals to save for retirement on a tax-free basis. This means that the money you contribute to a Roth IRA is taxed up front, but all future withdrawals, including any investment earnings, are tax-free. Tax-free? Yes, you heard that right. Here's how it works. When you contribute to a Roth IRA, you use what people sometimes call after-tax dollars, which means you don't get an immediate tax deduction for your contributions. However, when you withdraw money from your Roth IRA in retirement, you won't owe taxes on the distributions because you've already paid taxes on the money you contributed. For example, if you contribute $5,000 to a Roth IRA in a given year and your tax rate is 25%, you won't get a tax deduction for the contribution, unlike in G's prior example about the individual IRA. However, when you withdraw those $5,000 plus any earnings in retirement, you won't owe taxes on any of it. Zero taxes. For 2023, the maximum contribution limit is the same as for the traditional IRA, $6,500 for everyone younger than 50 years old, and $7,500 for people 50 or older. However, note that contribution limits apply across all your IRA accounts. So if you have both a traditional and a Roth IRA, your total contributions to both accounts can't exceed the annual limit. The Roth IRA is a great account. Tax-free withdrawals are a big deal. But before you open one, you should know that not everyone is allowed to contribute to a Roth IRA directly, however. You may be ineligible for a Roth IRA, or your contributions may be limited if your income is too high per threshold set by the IRS. So make sure to first do your research to make sure you are eligible. A Roth IRA can be an excellent choice for those who expect their tax rate to be higher in retirement than it is currently. Tax-free withdrawals can help you keep more of your money in retirement and potentially reduce the impact of taxes on your retirement income. Also, here's a fun fact. The Roth IRA was named after Senator William Roth, who represented Delaware for 30 years in the U.S. Senate.
Oh, wow. I didn't know that. Okay, so let's now talk about 401k accounts. A 401k is a retirement account offered by many employers in the U.S. The rather silly name comes from the section number of the U.S. tax code, subsection 401k, that established this type of retirement plan. Here's how a 401k account works. As an employee, you choose to contribute a portion of your pre-tax income, meaning a portion of your paycheck before taxes, to the account, up to the annual contribution limit set by the IRS. For 2023, the maximum contribution limit for a 401k is $22,500, with an additional catch-up contribution of $7,500 if you are 50 or older. That's a lot of money, especially when you compare it to the size of the IRA contribution limits. And similar to an IRA, it allows you to save for retirement on a tax-deferred basis, which means you don't pay taxes on the money you contribute until you withdraw it in retirement. However, the higher limits for 401k contributions mean that the potential tax deductions are much higher. For example, if you max out your 401k in 2023, meaning that you contribute the full $22,500 and your tax rate is 25%, then you can deduct a whopping $5,625 from your taxable income for 2023. I have never been sure why IRA contribution limits are so much lower than those for 401k accounts, and the difference really doesn't make much sense to me. But it is one of those arbitrary tax rules that you can't do much about. Also, similar to IRAs, the money in your 401k account grows tax-free until you withdraw it in retirement. But importantly, many employers offer matching contributions in 401k accounts, where they will contribute a certain percentage of your contributions up to a certain limit. This is essentially free money that can help boost your retirement savings. So, if your employer offers matching contributions, definitely make sure that you are contributing at least up to the amount of the match in order to get as much as possible out of that benefit. Otherwise, you will just be missing out on an important employer benefit. It's important to note that there may be fees associated with 401k accounts, and you may be limited in your investment choices. Some employers have plans that only offer expensive funds, so make sure to read the details on your 401k plan's website to make sure you're comfortable with the options you have. But overall, a 401k account can be a powerful tool for saving for retirement, and it's worth considering if your employer offers one.
Now let's talk about withdrawals for a minute. What if you want to withdraw your money from any of these accounts? In general, it is key to understand that these are called retirement accounts, because the government wants to incentivize people to leave the money in these accounts until traditional retirement age. Under current rules, you can generally start making penalty-free withdrawals from your 401k and IRA accounts at age 59 and a half. If you withdraw money from your 401k or your IRA before age 59 and a half, you may be subject to a 10% early withdrawal penalty. Once you reach age 72, you must begin taking required minimum distributions, also called RMDs, from your 401k and IRA account each year, which are calculated based on your life expectancy and the balance in your account. Also, remember that in general, you always have to pay ordinary income tax on the amount withdrawn from a 401k or traditional IRA account. These accounts are tax-deferred, not tax-free. For Roth IRAs, withdrawal rules are a little bit different. Generally, contributions to a Roth IRA can be withdrawn at any time free from tax and penalties, as they were already taxed before being contributed. But what about earnings? If you are younger than 59 and a half and the account has not been open for at least 5 years, you may be subject to a 10% withdrawal penalty, in addition to ordinary income taxes on the amount of earnings that you withdraw. At age 59 and a half, you can generally start making penalty-free withdrawals from your Roth IRA, as long as your account has been open for at least 5 years. Also, there are no RMDs for Roth IRAs, so you can keep the money in the account as long as you like. So many rules.
So many rules. There are many other types of retirement accounts in the U.S., but these three are the main ones most people should know about. Other noteworthy accounts are the SEP IRA and the Simple IRA. A SEP IRA is a retirement account for self-employed individuals or small business owners. Contributions are tax deductible, and the contribution limit for a SEP IRA is much higher than that of a traditional IRA. A Simple IRA is a retirement account for small businesses with fewer than 100 employees. Contributions are tax deductible, and while the contribution limit for a Simple IRA is lower than that of a 401k, it's still an excellent option for small business owners who want to provide retirement benefits to their employees. So, there it is. We hope that you enjoyed this quick summary of the main type of retirement accounts. This is, of course, very basic information, and there are lots of interesting exceptions and workarounds for all of these accounts.
For example, did you know that it is possible to access money from your 401k before age 59 and without paying a penalty or income taxes? We will talk about that in a future episode, so please make sure to follow this podcast. Also, please leave your comments and questions in the comment section below, or send us a DM on Instagram at GayHusbandsOnFire. Thank you for listening to this episode today. We really appreciate you, and we hope that you find all our content helpful and fun. Make sure to follow us on Instagram, and subscribe to our YouTube channel and our podcast. And remember, there is a pot of gold at the end of the rainbow. Let's go find it together.